Thank you all for coming out. The subtitle for Tony's talk is Tax Cuts and Jobs Act, Who Wins and Who Loses? So it's going to be a very enjoyable presentation, I'm sure. Let me tell you a little bit about our speaker, who said we should say he came, he saw, he left. But he has a little bit more of a resume than that. Since 1989, Dr. Curatola, better known as Tony, has been the Joseph F. Ford Professor of Accounting at Drexel University in Philadelphia. He is the tax column editor for Strategic Finance and has been since 1992. He has served as the editor of the Journal of Legal Tax Research and has held a variety of leadership positions, including current national service with the Institute of Management Accountants. He has been called on to provide information to the House Judiciary Committee concerning the source tax law, and he is a regular contributor to numerous professional journals, including The Tax Advisor, Taxes, Oil and Gas Tax Quarterly, National Public Accounting Benefits, Benefits Quarterly, Tax Executive, Journal of Pension Planning and Compliance, and Tax Notes. Who knew? Dr. Curatola has completed sponsored research on the taxation of retirement income, something near and dear to all of us. And the research is across states and across gender lines. He's done that for Louisiana Accounting and Education Foundation and the International Foundation of Employee Benefit Plans. His externally funded research findings have appeared in media such as Forbes magazine, the Washington Post, the Wall Street Journal, the New York Times, and recently he has been seen on the Wealth Channel. So we are delighted to welcome Dr. Tony Curatola. Ayatollah Pure.
Okay, I'm running for office. $20 non-sequential is fine with me. No, I don't need anything. I just, do you have a machine to?
Yes, and you hit the
What's that? Page down. Cool. Okay, how many people think this was good legislation we just had passed? How many think it was bad? How many of you are not sure? Interesting. I work in it. I have no idea yet. I've crunched numbers. I've looked at it. It's actually case specific. And part of the problem is this. If you have a tax bill where you change one piece of the law, you can see how it falls through. When you change thousands that all interact, it's unclear. So we're not sure at times who's the winner, who's the loser. And so what I'm going to do here in just 1 hour is bring this down to where I'm going to show you a variety of the issues that affect individuals. Show you some quick numbers, which you can't quote because we ran the numbers making some very strong assumptions. And many of the numbers I'm going to put up are not going to agree with the media. And the reason it won't agree with the media is because most of it was based on last year's tax information. And I'm using what the numbers would have been in 2018, which happen to be the same numbers that the new tax bill is based on, or is. So it changes some of the glitz of it, so to speak. Okay? So, many wanted simplification. You've heard that for years. You're around about as long as I have, and all we've ever heard, oh, why can't it be simple? And we even had a president say, I'm going to put out a postcard. And all you got to do is fill it out and just put your number down and then write your check. And people would say, Tony, you're going to be out of a job. And I go, no, I'm not. Because in order to get that one number that he wanted, you had the whole tax law that we currently have been working with, which is 11,000 pages, plus or minus. Okay? So I'm unimpressed by it. So let's see what happens. Well, TCJC seems to have provided some simplification. Many of us would say there is some simplification here. But as many of us know, should I face this way? Be careful what you wish for. And you're going to see some of it now. Okay? Also, I should say, if you have a question, feel free to ask me. I'm happy to answer it. You don't have to wait till the end. I'm not intimidated whatsoever. 2, I cannot answer questions that are personal tax matters. Number 1, it's unfair to the people present, and number 2, legally I can't do it. And you wouldn't give me enough information in order for me to answer it. Okay? So that's kind of the little ground rules we have. Oh, and number 3, I have no idea what I'm talking about. So there's no problem. Okay? So I'm qualified now to run for office, okay? That was not nice, I'm not telling you. So let's see some of these changes, see what happens. First of all, here's your tax rates. This is the big area that everybody talked about, okay? The top line, that's our new tax rates. 10, 12, 22, 24, 32, 35, and 37. The bottom, at note number 1, the 10, 15, these are the old rates that we had last year and would have been in play had we not had a tax law. So immediately, notice a couple of critical issues. They both start at 10%. So the lowest income people, nothing happened here, baby. We all the same. 15 has dropped to 12. All the others have dropped with the exception of 35. 35 is still held in place, which we'll come back to later. These are the rates now. The 37%, where there was a lot of complaining, why did the younger people get that? Why'd you cut it back? They should have stayed at 39. Fine. Doesn't really make that big a difference. There's not that many people paying that large a tax number yet. So, the first thing that's changed, standard deduction. Many people, you have a choice. You can either take a standard deduction or itemized deduction. Okay? The standard deduction has been jumped from $13,000 for a married person filing jointly to $24,000. Immediately people say, yeah. Be careful. There's going to be another thing come down the line in a moment. Head of household jumps from 95 to 18. Single goes from 65 to 12. The critical issue to look at here is what we refer to as the marriage penalty. Okay? The marriage penalty issue is 2 single people earning income, same amount, they pay taxes at the single rate. Married couple, husband and wife, or I have to now say, spouses, they've earned the same amount of income. Don't get into that argument with me. I'm assuming they do. They will pay more tax than these 2, single. So the old joke was at the Thanksgiving table was to turn around and tell my parents, get a divorce, live together, and I can save you taxes. Catholic, Italian, you can do the math. It may not go over well. Interestingly, though, I expected my mother to be upset. She liked the idea. Figure that one out. Here's the secondary piece. Personal exemptions. Gone. So $4,050 or $4,150, depending what year I look at, you no longer have it. So consider, go right back up to that top. I said the standard deduction went from 13 to 24. Husband and wife, add 8,000 to the 13, that becomes 21 something. You just about have the issue right there. So the young folk who have these things called children, they don't have those extra deductions for itemized deductions. So I no longer have to walk into a client and say, okay, you have children, are you really supporting them, are they really living here, and go through all that litany. That's gone. That will eliminate almost an entire day of my teaching. Pretty cool. Took that much time to teach it. Jim probably teaches it faster than me, but then, I don't know what he does. This area, in and of itself, has changed majorly. So now let's look at some of the brackets. I'm going to start with the married filing jointly. Okay? First bracket, please notice old law, new law. 19,050 is the bracket limit. They're the same. If you read a lot of the media, they're going to show the old bracket is 18 something. That's because that was 2017's 18 bracket. And in 2017, if you would look at the Joint Conference Committee report, and that's the committee I look at to see what these people were thinking when they did what they did. Those numbers, we already knew what the numbers were going to be for 2018. They were given to us back in October. The inflation adjustments had already been programmed. those numbers were going to be 19,050. So it really didn't change. So when somebody says, oh, we made it wider, no, you didn't. It was going to be wider anyhow. 1950 to 77.4, surprise, no change there. The brackets are the same, but the rate did drop. You drop down from 15 to 12%. That's a 3% savings. 3% times $50,000, what's that, about $1,500? Okay, that'll pay for this year, coming year, and then the contributions you make to Jane's fund. 25 drops to 24. You notice they start the same, but notice it got wider. Not by much, but a little bit. 28 goes to 24. It starts higher up, but notice it stretches out a lot further. So you really are pushing people into a lower tax bracket from that perspective. Okay? Here's the classic. 33% went from 237 to 424. That's a big bracket. Notice the new bracket, 315 to 400. That's a little bracket. It's only $85,000. You're in and out of it very quickly. You guys aren't? What am I wasting? Never mind. You'll notice the old time 35% bracket was 424 up to 480, which was a small bracket back then. The new bracket goes 400 to 600,000. That's a pretty large bracket now. And then over 480 was 39.6. Over 600, it was 37. So our new bracket over 600 becomes, 37%. And of course, most people say, that's not me. Okay, that's fine. But the point is, I've got to look at that because you're looking at it from a policy perspective. And from a policy, that becomes important to me. That's a huge jump. So it means the upper income people will benefit to a degree on this. Okay? In some parts. They can lose on other parts too. So now let's look at the single. Again, notice 10, no change. 15 to 12, bracket, no change. So the very basic bracket where the bulk of people appear, you don't see a change. Look at this. We go from 38 to 93, but on the new side, we shrunk the bracket. I don't care, I'm married. Heck with those single people. That'll fix them. Anybody single here? Oh, sorry. Just write down, terrible presentation. I won't get paid, don't worry. 28 to 24. Again, notice the new one. Shrunk that baby again. Down to 154,000. 32%. You see a drop here. And notice at $200,000, there's your new law. You're kicking it in pretty quickly. Then 35% goes huge. Now, if you can remember from the prior screen, you'll notice here the upper bracket kicks in on single at 500,000. The upper bracket kicks in on married filing joint 600. That's what I call the marriage penalty. So if I have a couple, I would advise them, break up, live together, and there we go. That's assuming they're both earning income, okay? Which is common in today's world. Yesterday's world is over.
Can a married couple file as two singles?
No, they can't file as two single. They can file as married filing separate, and it's the worst tax situation. Yes. In the old days, we used to say the only time you did that is when one of the spouses was involved with the boys. Okay? Because then the spouse didn't want to know anything that was going on. Okay? Innocent spouse type rules. In reality, the way we would do that is if, in my case, we have a handicapped child. If my wife and I were both gainfully employed, we would turn around and probably file separately because we would put all the medical on one side of the bill. Together, we wouldn't be able to claim it. But separate, we would. That's about the only time we really do this in today's world. Okay? Do you like that? Head of household. Everybody know what a head of household is? It's the old rules that came into play because we had a lot of divorces, and the one divorcee would have the child. So in order to be a little taxpayer friendly, they created head of household. Okay? That's where this one comes from. Notice what happens here. There was always married filing separate, best tax schedule, single, worst, except for married filing separate. And then in the middle was head of household. Nice benefits up to here, up to here. You'll notice left side is the single, the right side is head of household. You notice there's an advantage, but notice what happens once we get to 51,800. There's no difference. Head of household now is treated as single. No benefit. Most people didn't even pick this one up. We picked it up when we started doing some of the work on it, to pick up the notices as to where the things were kicking in. So effectively, this is saying the head of household person no longer gets a benefit. Yes, ma'am?
You haven't mentioned children yet. Are there going to be deductions for children or?
No.
No?
No. Is that a hard one? I'm not sure. No, exemptions are gone. Exemptions are gone. So we don't care if you have kids or not. You know, you don't care if you have your parents living with you. My in-laws lived with us for 25 years. They were, you know, good benefit. At least on taxes. My wife's not here, so I'm safe. Actually, my in-laws wasn't a problem. It was amazing. I have to go this way.
What's the difference between single and head of household?
On the taxes?
Yeah,
Nothing.
no, I mean, the definition.
Definition, single. I got no one. Head of household. I got a leech. I mean a child or a parent or somebody who's a dependent. That's where it comes into play.
So if you have, keep the kid out.
That's another way to put it. Look, you want to do this? I can sit.
I had a question. These brackets, how are they, who is responsible for actually putting this together? Is there a committee, or is there a group of academics, or how is it determined?
Are you seriously asking me this question? I mean, you're taping me. You do realize. This is done by Congress's staff. When staff works on new legislation, okay, you know the congressmen or congresspeople come in and present all these new bills they come up with. Your staff does all the work, and the staff creates it. But keep in mind, what are they doing? You have to turn around and say, how much money do we need? How can we change it? How do we tweak it so that we get the revenue we need, but we still do what our so-called policies want to do?
I have one follow-up question. Do deficits matter? And how about, does it matter? Basically, I could say we're going to get 6% growth if I do this, and, we could eliminate taxes almost,
I would like to assume that deficit is something they think about, but you and I both know, you've read enough of the media, the same as I do. When we talk about deficit, it's kind of pushed aside. That has not been an overreaching issue. In your household, you've got to make ends meet. Their household, you just run a deficit. There's nothing new about that.
Does inflation matter?
Well, inflation does.
Or disinflation, either, up or down, does it matter?
Well, inflation does have an impact here in one side. Almost all these numbers we're looking at, they're actually going to be adjusted for inflation. So every year they're going to change. However, the adjustment will change from what we did in the past, where we used CPI, the urban ratio. We're now going to use the change CPI urban, which moves slower. So the question you're next asking, what's the key difference? The urban just assumes a certain amount of change within your buying pattern, and the chain one assumes substitute products. That's why it moves at a slower rate. So we're going to see these numbers adjust differently. And we've already had one problem with the new law because they implemented it incorrectly on one piece of the law So things are out of kilter right now. So I'm sure we're going to see a correction on that. Okay?
But just a follow-up question?
Yeah.
If inflation comes back and it's roaring, which it might, that's always a possibility, what effect, it's going to have an effect on our debt repayment and our capability to pay down debt, right?
Yeah, absolutely. I mean, there's no question about these things, but again, as you and I both know, Congress is an evolving group. They're in this year, they're in for 2 years in the House, they're in 4 years in the Senate, or 6 years in the Senate. I mean, I'm looking at the Senate more than I look at the House. The Senate has got some stability, and that's where most tax matters are driven, as opposed to the House. Okay? So we're looking at that. Is there going to be changes? Yeah. Do I believe, like some people who I've heard make presentations say, well, just deal with this because in 2 years it's going to change when we have the next election? I'll tell you what, I'll be happy to come back here in 2 years and say, no way, right? It can't happen. For a simple reason, in order to get legislation passed through the House and Senate and a president, you have to have everybody in agreement, which means you have to have a majority. So if you have majority in one or both of the houses, you still have to have a third person, the president. Because if the president says no, you now have a veto. So at least for the next 2.5 years, this thing is in play. Now, again, is it a bad thing? It's still not clear that it's a bad thing, okay? If for no other reason, if you remember a couple of weeks ago, we've already seen the notion there are more jobs in this country. And that concerns me a lot more. Because you don't have jobs here, what are your grandkids going to be doing? So, you know, there's a give and take here. How it's all going to play out, I don't know. I don't have that kind of a Ouija board in my house. Shoot.
What does this have to do with jobs?
Because the other side of the fence is the business side, and because of the tax cuts on the business side, businesses will be able to, and have already started hiring more people. If they're able to theoretically lower prices, that should improve trade imbalances. I'm not going to get into the tariff, please don't bring it up. I heard that and I just sit and go, oh, okay, let's get a tweeter going.
When I write through the 1040, and I claim my wife and myself have exemptions, was that just a lot of kids or?
You mean when you're doing your own tax return?
Yeah.
There's no more exemptions.
Any, you don't get that
None at all.
$4,000
Not you, not your spouse, no adoptions, no people in the street you bring in, nothing. Okay, go on. History, yes.
The population are in each.
What part of the population is in? I looked at some of that this morning. Interestingly enough, if you're looking at the 35 and 37% brackets, you're looking at less than 10% of the whole population. There's not that many people up there. I always love when they say, well, let's throw it up there. You can't get that much money out of it. There's not enough people to pay that tax.
Because half the population doesn't pay income tax anyway.
Say it?
A large part of the population doesn't pay income tax, do they? If they're earning very...
You know, it's interesting you bring that point up. If you go backwards in time, there was this idea of reducing taxes, get people off the tax rolls, we call it. And the group that they were looking at were the retirees. So many retirees actually got booted off it because the change in the standard deduction, the change in the itemized area, the change in the personal exemption was not a problem because they didn't have enough money. They only had Social Security income. But in today's world, the vast majority of people when they retire are collecting retirement income, collecting Social Security, and Social Security is now taxable up to 85% of it. So that group that was sort of kicked off the rolls, if they're still alive, I can almost assure you they're on the rolls today, and many of us didn't even know they were on the rolls. Because once somebody's off the roll, you don't think to go back and say, well, have things changed in your life in 10 years? Who would think of it? You'd say now they're 85 years old, they probably don't have any more income, so we didn't bother checking. Anyone else?
eliminated the exemption for children, was there any discussion in the committee about the effect that that policy would have on population growth?
Good question, and I'll tell you what. I told you we took it away here. Remember I told you there's a lot of moving parts? You're going to see another moving part come in later on that you're going to say, oh, wow, we took care of that.
Oh,
I told you I don't know what I'm doing. Anyone else? Okay, so let's look at the itemized deductions. This is the area that has most people in concern. Okay? I would argue that the vast majority of people are not going to itemize next year, including myself most likely. It's just hard to imagine. Okay? Interest, which is the issue you're bringing up. If you bought a house up to $1 million, you could write your interest off. If you had equity debt up to $100,000, you could write up the interest off on that. Okay? Next year, this year, 2018, equity debt, zippo, none. Acquisition debt theoretically cuts down to $750,000. But if you already have a house, you already have your mortgage, it doesn't matter. You're still in play. The old joke when I was growing up and when I would teach some of my policy people, I want to die with a 100% mortgage on my house. Why? Because I was able to write the interest off. And under the rules, as long as I had the mortgage, the interest was still good. And I could still write it off. Where can you get debt for less than 2%? There's no place. And then I could invest, and my broker did a good job. Taxes. This is the one that's all got New Jersey, New York, California up in arms about. Oh my God, this is unfair. You're limited to $10,000, which means $10,000 maximum on property taxes, income taxes, and for anybody who's unfortunate enough to work in Philadelphia, you might need to blip that out. Wage taxes.
How about sales taxes?
And, well, sales taxes was the alternate for the, state income tax. So that's still in play. But again, you're limited to $10,000, no more than $10,000. Okay? Maximum amount. That's the one in New Jersey, New York. You heard them all screaming, we're going to file an injunction. It's unconstitutional. I don't know where constitutionality came into this argument at all. It just sounded good. And that's about it. Nothing more than that. The fact of the matter is, I didn't hear those three states screaming for the last 20 years when they were being subsidized for their behavior at my expense. Sorry. I have a little sympathy on this one. Okay? And it doesn't matter what your tax filing status. This is the problem child. So it means my single person here has up to $10,000. And remember, her standard deduction was 12. So there's a high probability she'll be able to itemize. Tony Curatola is married. My standard deduction is 24. And I can only take 10. So being married, any good attorneys? Charitable contributions. This is the one that was funny. We all thought it was going away. Instead, it stayed in. Not only stayed in, but it grossed up to 60%. Yeah, it doesn't affect me either. So if you made $100,000, you could give $60,000 now away and be able to deduct it. Anything over 60, you got to carry it forward. That's not me. It was 50. Okay. I guess that was to satisfy somebody. I just haven't quite figured that one out yet. This is the one that's kind of interesting. Casualty loss is gone. So if you have a casualty loss, there's no more deduction, no more of that 10% of AGI, $100 deduction. For those of you who can't appreciate casualty loss, you have to understand some of its history. Part of the history on this goes back to people who own boats. Okay? Take their boat, have a little bit to drink, crash the boat, and then go to the insurance company and get reimbursed. And that works the first time. The second time, the insurance company says, nah, we're not going to reimburse you. And they say, no problem, I'll write it off on my taxes. So Congress put in the casualty loss thing, 10% of AGI, blah, 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 blah. Now they're wiping it out. They're gone. So the casualty loss area is now gone, except if you have a presidentially declared disaster. Oh, yeah, we're going to hear that all the time. Here we go. And as a person who lived in Louisiana for 10 years, or 8 years, it's very an interesting area. Medical. This is the one that's also acute. The medical side of it is you had to have the hurdle of 10%, which kicked in 2017. Okay? Prior to 17, it was 7.5%. Then there was an adjustment for being over 65. We'd be lower for that group. Well, Congress came in and said, okay, we're going to get rid of the 10% in 2017 and 2018. We'll make it 7.5%. And then in 19 forward, it becomes 10% again.
Why did they do that?
To make elderly people feel good? I don't know. This is one they did not spend a lot of time explaining their thoughts or any of that. Now, I have to be honest, I've heard a lot of comments of, if this had taken maybe 2 or 3 years, this stuff would have been fetted out, we'd have had time to discuss it, blah, blah, blah. Hey, 1986, remember that one? That's probably the major tax bill of all times. Guess what? They had 3-4 years that they dialogued on that thing, and we're still making corrections to it 20 years later. So, it's typical. I don't care how long they're in play, we're always going to be, there's problems with it. By the way, I'm not defending these people, and I'm not praising them either, just reporting facts. And no, I'm not the needy. The P's limit. The P's limit was where you had too many itemized deductions, you made too much money, and you started losing some of your itemized deductions. You could lose up to 3% on every dollar, so $3 on every 100 over the limit, up to a maximum of 80%. Believe it or not, this one kicks in on the upper income people, usually the people that were in those two brackets, the 35 and 39.5%. They're the ones that got hit with this one for the most part. So they lost a lot of those itemized deductions. This is gone at the moment, at least, and most of the stuff I'm presenting is suspended. It's not even repealed. It's suspended until 2026 because they couldn't get a supermajority of 60 votes. So therefore, they can only put it in temporarily, the 10-year, what we call sunset provisions. Shoot.
Quick question on the casualty losses. Does that also apply to businesses as well as individuals?
No, the businesses are still safe. You can have all your casualty losses you like. So now you can put your boat in as a business item, but I can assure you the IRS is going to challenge it and say, no, it ain't. Because all the parties you have on there don't count. But again, I told you, I don't know what I'm talking about. Much. Miscellaneous deductions. This is the real problem child for many of us. The miscellaneous deduction item is gone. Now, most people would look at it and turn around and say, big deal. It is a big deal. And the reason it's a big deal is this. Tax preparation is no longer one of the deductions. Well, truthfully, we don't really care about that because it's too small for the most part. Okay, most people, because it was a 2% hurdle. So 2% you had to have usually over $4,000 or $5,000. No big deal there. Unreimbursed employee expenses. That's a little bit one. Okay, some of my colleagues at the university are upset. Okay, because they had to pay for their conferences, they were deducting there and things like that. Yeah, I agree. Okay, that one will kick in. Hobby expenses. This is the big problem. So here we go. Okay? Catherine over here is in the hobby of selling dope. She goes, right, that's on camera. I want that documented. If you start a hobby, it's very hard in our profession to determine when you have a hobby and when you have a business. There's that very fine line between the two. If you're a hobby, you can never have a loss. You can only have profit or zero. No losses. In a business, we can have losses, take them back, carry them forward, things of that nature. But as a hobby, no. What makes this one even more difficult now is hobby. You sell those paintings, here's your income up here. You have expenses. You bought paint, you bought the canvas and all that. It's down here in the itemized miscellaneous. But since you don't have itemized miscellaneous anymore, you can't expense it. So you only have income. So now all of a sudden, the hobbies could become a nightmare. Because now I'm going to want to elevate it to a business. And I can assure you, that's not an easy task. Okay? That's a challenge. So there you go. That's part of the game. Investment fees. This is the one I get calls on right now like crazy. Hey, Tony, I've got an idea. Can I do this? No. Why not? Because it's illegal, number one. Number two, if you do it, you didn't do anything, you still have a tax problem. I'll call you back. Do that. So for those people who have managed accounts with your brokerage, and you're paying them $10,000, $15,000 a year, and we were writing them off over here, you can't write them off now. So now you have people saying, okay, can I turn around and have the money come out of maybe my IRA or out of something else? And the answer is, yeah. However, all you did is make it taxable. So, big deal. You didn't accomplish anything. Well, how about if I take it out of my Roth? Why would I take something that's tax-free out of a Roth to pay something like this? That doesn't make sense. So, we've got a little problem here. And I'm going to be curious to see what kind of thoughts we come up with over the next year. Okay? Alimony, I like this one. This is my favorite one. Jim likes this one. Alimony, all of a sudden it's no longer deductible and not includable. So I divorced my wife, and my wife says I want $100,000 a month. Right. Assume I gave it to her. She paid tax on it, and I got a deduction. Beginning in 19, it's not deductible and not includable. Interesting. Many people come back already and they're saying, oh, boy, that's really good. Well, first of all, let's face it, it's a market out there. So you got two attorneys, you know the attorneys are going to argue this down, the numbers are going to change, and so forth and so forth. So we're going to see changes there. However, the part that becomes more interesting is in my world. Why did they come up with this one? A Supreme Court holding in Gould versus Gould that said alimony really isn't income to the recipient and not a deduction. Please notice the date that that decision occurred. 100 years ago? And they just read it? I could go on in midnight shows and have a field day just with this law. Estimated treasury, $8.3 billion from this change. Now, the interesting piece here is I disagree on the policy aspect of it. Now, and here's the part. I don't care if you say it's not deductible and it's not includable. Fine. That's your policy. I'll live with that one. However, if you're saying now that I've given my ex-spouse X dollars, you can't tax me as being single. You would need to tax me then as married joint because it's family income, ex-family. Ooh, no, that's not the way it works. I don't care how it works. I'm talking policy now. From a policy perspective, right now I would argue this piece of legislation, the provision, doesn't meet the smell test. Will it change? I doubt it. But from my point of view, if I'm divorced from my wife and you're going to tell me I got to pay tax on it, then I better get a lower tax bracket. Or she ain't getting money. Moving expense and reimbursement. Here's another one that's going to kill people. No longer deductible. And if the company pays you, it's includable. You can imagine all my students who are basically saying, I'm going out into the job and the company's going to pay for me to move to New York, you know, wherever. They pay, you got income. You pay for it. Quite frankly, I was hoping to retire some moment and move somewhere else where it's warm and not Florida. Can't stand those bugs down there. Go to Texas at least. You're going to go down there. Great. Figure, fine. I'll deduct my moving expenses. Now I can't. Okay? I know none of you bet. So but I put it up here just in case you might have gotten into a conversation. Wagering. If you're playing in games and for that kind of nature, and you have tax elements here, it's been interesting over the last couple of years how it will be handled. Under the new rules, traveling costs to and from the casino now count. Never did, I know. This one. So we now know who gambles. They clarified the amount of wages. I like this on exotic wages. I was sitting there laughing because I was on a plane flying with my wife and I'm laughing. She says, "What's your dirty $9.50 up now?" I said, "Exotic." I was thinking what that might mean. She said, "Keep your mouth shut." Not behind me. He caught on very quickly. It actually means trifecta, daily doubles, things of that nature. Okay, that's what they call exotic wages. So if you do a trifecta, you're basically picking 6 different games. You're putting $2 on each one. Under the rules, you would turn around and say the $2 against the one bet is the only one that would count. This was to determine how much money had to be paid, whether or not there was taxes to be withheld. That's what the deal was. In this particular case, they changed the rule by Treasury last year and said, no, that doesn't work. We're going to say if you pay $12, the whole $12 is a deduction. As simple as that. Now, the $12 bet doesn't affect you and I. But you have to understand something. There are people who play trifectas where they're putting down a couple $1,000s. This becomes a big issue. Okay? A major issue. In 2017, we now hold that it will be considered a $12 bet. As simple as that. Okay. The final regs, though, become effective on November 11th. So if you make these bets on the 10th, you lose. If you made it on the 11th, you're okay. That's the only thing that drives me nuts in my world. These effective dates. I mean, make it the end of the year, make it the beginning of the year, I don't know. I don't care. But just give me a break. To claim a loss here, a person needs to itemize. So if you don't itemize and you have wins, you can't write them off. So you're forced to itemize. That's one of the problems with the game. Okay? Remember I told you we took away the personal exemption? Oh, here's where we're giving something back to the lower income person. Not the lower income, to the family. We're going to turn around and change the child care credit from $1,000 to $2,000. That's a big jump. But not just $2,000. We go beyond that here. We're going to change the phase-out limit. The limit used to be $110,000, which meant Tony Curatola couldn't write his kids off. It's now going to be $400,000. All of a sudden, I can. $200,000 for other taxpayers. So notice the marriage penalty is still in play here. It's not. It's eliminated. You got $200 and $400. So now you got a $2,000 child care credit being given to this population. And it goes one step beyond that. I've learned how to use that animation. It's great. There's a $500 qualifying dependent. Now I did check, and I was told that the ashes of my in-laws, even if they're on my mantle, I can't write them off as dependents. I have no sense of humor down there in the IRS. However, my handicapped daughter does count. Better than that, if you're also taking care of your parents, the old rules would have said that parent had to be living with you. Under this, they don't. They can live in their own house. As long as you are providing the support for that house. And there's a variety of ways. Talk to your accountant about that. So let's take a look at what happens here. Here's the non-quotable part. Okay? This is to make your day. You guys have had enough time for the food to digest. Anybody vomiting? Mushrooms right there. I'm not guaranteeing these numbers. We've run these numbers a dozen times, and I swear every time I run them, I come up with a slight difference. However, personal exemption. Personal exemption with 4. The 4 people, now realize we don't have personal exemptions, but it gives you the guideline of what the family is comprised of. So here we have a husband and wife on the left, and on the right we have a husband, wife, and 2 children. Okay? So notice, the old tax law, new tax law. You'll notice very quickly that the tax rates actually are reduced for these people. Now, this is assuming they only claim a standard deduction and nothing else. And they did it last year, and they're doing it this year. So if you say, well, what about the person who had itemized deductions? I can run the numbers, and we find out it takes quite a jump, like over $40,000 in itemized deductions, in order to make this not beneficial. Sort of get to a break-even point. Okay? So it's not as bad as at first looks, from that perspective. Okay? I'm not telling you it's great. I'm just saying it's not the hammer coming down. You'll notice down, and this was the thing that I've already got a lot of grief on. Well, look at that. Don't you think that's unfair, Tony? Look at that. The $50,000 person is only going to get an $800 saving. But look at that person up there at $350. They're getting almost $16,000 back. They also put in a lot of money. I mean, you can't give money out if you haven't put anything in. So unless you turn around and make them zero, there's no way around that one. Okay? So that's where that area is coming from. Notice on the right side though, and the reason I stopped at 350 because that allows me to capture all the married people who were getting the $4,000 of child tax credit. Because that's the new rules. Okay? Under that, and that's the reason why you notice it's 110, everything's in 50 increments, but the one I started off with 110 because that was the stopping point. So it gave me an idea of where it was to illustrate clearly what's really going on here. Okay? So you'll notice on the far right side, the numbers go downward significantly. Okay? So the married person actually doesn't do so bad under this provision if they weren't possibly in New York or New Jersey. And then even there, I don't think it makes that big a difference. But I didn't write their numbers because my mother lives there and my brother. Here's the single taxpayer. Notice the single. The single one has about the same effect, not as big, but not surprising. But notice what happens when you hit 350. Like that blue highlighting? They pay more. That'll teach those single people. Yeah, they should be miserable like us. Interesting. Okay? And again, remember, very restrictive assumptions are put into these kind of numbers. So you can't walk out and say, well, this is what it means. No, it doesn't mean that. It just means this is an idea of how it can affect certain people. Generally, it depends on what your situation is to determine whether it's good, bad, or indifferent. Okay, so let's move on to some of the other pieces to the puzzle. The kiddie tax, which is always a problem. Everybody knows what the kiddie tax is? Kiddie tax, I have a child. My child is out there, I've taken money out of my account, I've put it into there so they have unearned income. In other words, investments. In the past, their unearned income had to be added on to my income to figure out what the tax is, so that it was taxed at the highest rate possible, and then put back. One of the problems we had with it, you couldn't do their return until they did my return. And they couldn't do my return because unfortunately I had partnership income, and partnerships have a tendency never to give me my information until late, so I always had to file for amendments. Extensions. Amendments, extensions. So I couldn't do theirs until they did mine. Under the new law, they're going to change it. And what they're going to change it to is say, okay, we're going to disentangle. We're going to say the child files their own tax return. Taxable income, earned income will be taxed like anything, single person. Unearned income will be taxed as if it were an estate or trust. In other words, we're now going to get a very high tax bracket. You'll notice the rates down there, 10, 24, 35, 37% once you're over $12,000. Well, that sounds really bad. In order to have $12,000 of income, how much investment did this person have? A couple $100,000. Sorry, I don't want to hear it. Okay? That's where that one's coming from. Dividends, capital gain. That did not change except for the rates. This is the one area we have a little bit of a problem right now. There's a glitch. And the glitch is it's always been 0% if you're in the 10, 15%. 20% if you were in the 39. Everybody else was in the middle. Under the new one, it's 0, 15, 20. Same brackets, except instead of using the new numbers, they did the chain CPI adjustments last year. which changed the numbers. And if I were to actually show you people the difference, it's like $1,000 off. So it's unclear. It's not, it's purely those in those tax brackets. We're going to see a change. There has to be. Okay? Somebody's going to figure it out that that's a problem. So nothing's really changed there. That's pretty much still in play. AMT. AMT, everybody thought was going to go away. It didn't go away. Everybody was upset about it. On the other hand, AMT may not be so bad now. And the reason is, under the old rules, AMT, you had an $84,000 exclusion. But if you made $160,000, you started losing the exclusion, you basically lost it. So you never had it. AMT kicked in right away. Under the new rule, AMT doesn't phase out until $1 million. Big difference. So, on the one hand, AMT, you're going to get the exemption. It's not going to kick in right away. And it's not going to phase out right away. And if it does phase out $1 million, nobody's going to lose sleep over that money. That's an argument. Nobody will win. Retirement issue. This was a tough one. Last year we were telling people to do a conversion from their IRA to the Roth IRA, and if the tax rates change, we could always throw it back in the IRA and then bring it back over. We call it recalculation, reconversion. We had all kinds of good games we were doing. I've even advised people on this. You can't do the reconversion anymore. So once you move it from the IRA into the Roth, that's it. You can't move it back and play games. It's the only one that comes into play. So if I'm taking it out of my retirement plan at the company, moving it into an IRA, then I want to move it to that, that's fine. That's not recharacterization. The recharacterization is purely a traditional IRA to a Roth. You can't go backwards. Contributions. You're limited to an annual gift. This is the one where my pastor always hates my guts. Because he turns around and says it's always better to give than receive. In the tax world, it's better to receive than to give. Because when you receive, there's no tax. I gave my kid $500,000, there's no tax on him. But I have a tax problem because I gave it to him. So I've got to pay the tax on that as a gift tax. That's where it comes into play. Well, it's $15,000 this coming year. The beneficiaries now, the ABLE account. ABLE account was a very neat little thing set up to allow us to put money in for a disabled person as long as the disability occurs prior to age 26. Limited to the gift amount. So I could put $14,000 or $15,000 in per year for, in my case, my daughter. Now what they did is they came back and they said, okay, you can not only do that, however, if my daughter earned income, she could take the earned income and put it into the ABLE account. And more importantly, she could also get the retirement contribution savings credit. Nice couple $100 or something. It's kind of a neat idea. I don't know how they came up with this one. I still haven't run the numbers here, so I'm not real sure if they're good or bad on it. Except it's still a nice thing. This was the other piece to the puzzle. If I had a 529 plan set up for my daughter, and we used to laugh about this in the years going by, you had the 529 plans, you would turn around and say, the ideal thing is, an ideal plan, 529 plan for your one child is set up on a limitation, but it may not cover all the costs. So if you had a handicapped child, set one up for them. They're not going to use it. And then later on, you can try and convert it over to the other child. Still one of your own children. Okay? It was legal. It's kind of interesting. Now I can take the 529 and roll it into the ABLE. That's a nice deal. Also, what's better, and I didn't do this research. Actually, Jim, my colleague, did. Jim worked in the area of the ABLE and also found that under some of the new rules, we can turn around and put the money in the ABLE and not have it affect that person's Social Security drawing. Where in the past you were losing some of it. So this became a pretty good thing. So anybody has questions on that, Jim will be happy to answer it. He thinks he knows it. I haven't gotten sued yet, so I don't care. Surviving spouse. The surviving spouse, here's the old routine. Okay, spouse deceases, so for the next 2 years you could claim the surviving spouse. The old rules, you did it just because the spouse died. In the current rules, you had to have a child. And not only did you have to have the child, you had to be able to file the joint return with the spouse had they lived. The child, stepchild, had to be an exemption that you claimed. the child had to live in your house with minor, okay, vacation, school, things of that nature. And they paid more than half the cost, which is always an interesting trick, okay? Under the new ones, we conformed this to the head of household rules that came out back with the Working Families Tax Act back in 2004? About there, plus or minus a couple years. That's 13 years ago. They just figured this one out again. You know, it's really crazy. So under this, you can now change the name from surviving spouse, although a lot of legislation still says that. We changed it to qualifying widow, widower. The qualifying child could be single, but you don't have to claim the exemption. Or, the household is maintained by a taxpayer for the parent's principal place of abode. So your parents, my wife, my mother lives down in Hamilton. Theoretically, if I was taking care of her, I could claim it under this if my wife were not around. Okay? So that's where the game is coming into play. Kind of an interesting rule. The gift rules, no gift tax return. Most taxpayers don't have an idea on this one. This is a cute one because my parents called up one time and said, hey, I'm going to give you and your wife a gift. Fine. Less than $28,000, yeah, no tax return. Forget it. It doesn't quite work out that way. You might have to file a return. Even though there's no tax, it depends where the money came out. So if it came out of my personal checking account, no problem. If it came out of our checking account, now it's a joint account, now we have to file a return basically saying that the two of us agreed to this. Okay? We laugh about it because when I present this to the accountants, they're all looking saying, are you sure, Tony? Yeah, unbelievable. I couldn't believe this either. So, you know, it's kind of weird. 15,000 is in 2018. More than 14, you have a gift tax issue. We have a lot of other adjustments. There may not be really a gift tax because we have a lifetime exclusion. There's a lot of Mickey Mouse rules. The thing I tell people, the first thing you got to remember when you're dealing with a tax issue, talk to the tax accountant first before you do it. I always hate it. They call and they say, hey, I did this. Is this okay? No. Well, what do I do to get rid of it? Shoot yourself. What can I tell you? I mean, if you don't call me first, I can't tell you what we're going to do. Once you've done it, the game's over. Now we have to deal with the rules. The end. I'm done.